Can you guys hear me?
Yes, we can.
Okay, thank you.
Trustee Martin, it is just 9 o'clock. We do have all of the trustees that we were expecting present. Tracy, were we expecting any of the non-voting committee members? Had you heard anything?
Nobody confirmed with me. I do believe that several may have confirmed with Heather.
Oh, I see Eric's. Oh, they're starting to join now. Okay, thank you.
Good morning, everyone. It's Eric Hayward.
Good morning.
Morning, Eric.
And Kelly, just to let you know, I have to leave at 10:30, so I'll just sign off when that moment comes.
Okay, great. Eric, I'd like to thank you for, this is your last meeting. I'd like to thank you for sharing your time and talent with us. It definitely helps a lot to have expertise from outside the board helping us with these decisions. So thank you.
Thank you, Kelly. Much appreciated. I've enjoyed being part of the group. It's a great group of people, and I've learned a lot from it. So thank you.
Interesting tidbit of information. Eric and I got to meet in person in Fort Kent, about a couple months ago with his work.
Yes, it was back in May. Yeah.
Yep. So
I always enjoy it when my travels take me to the county. It's a great spot.
Good.
Great place.
I'd like to call the investment committee meeting to order. And just a little bit of housekeeping. Remind everybody to please leave your mics muted when not speaking. And I'm going to ask Ellen to take a roll call for the meeting.
Certainly, thank you. Welcome, everyone. Trustee Bartholomew.
Yes.
Trustee Donnelly.
Yeah, here.
Trustee McMahon.
Here.
Trustee Martin.
Here.
And I do know that Trustee Gardner is not able to join us, and Trustee Rotundo is sitting in on the meeting as well. We're all set to start.
Excellent. Thank you, Ellen. And welcome all to the meeting today. And thank you for your time here with the agenda we have in front of us. Tab 1. Every year we bring the investment committee FY 2022 work plan in front of you. And basically it's basically what we have, an overview of the agendas for the committee for the fiscal year. The investment committee's fiscal year 2022 work plan is just presented for your information. So this is not an action item. The plan will also be included in our meeting, our September 27th, 2021 board meeting for information for the other trustees. So basically, if I know you guys have all skimmed through this, read the material, but it's basically the committee's responsibilities and duties for the year. Goes through what every meeting entails: September, December, March, and May. The committee authority, the duties and responsibilities, and the membership of the committee. So it also tells us the staff that's included in these in the investment committee. So I don't know if anybody has any questions or in regards to the investment committee work plan. We'd be happy to answer any questions that everybody's fine with the work plan as presented. Excellent. So moving ahead, I'm going to pass the gavel to Mike Pratico from Cap Trust. And Mike is going to go through the defined contribution plan for the quarter end June 30. And Mike, are you here?
Sounds good. Yes, and thanks a lot, Kelly, and good morning, everyone. And just an acknowledgement from someone. Can you see the screen okay that I just shared? Okay, thank you very much. All right, well, I'm going to go through what should be a fairly straightforward quarterly review here, and then we have one additional agenda item at the very end. But I'll go through starting with some really retirement industry updates. We used to call these topical spotlights. We now call them industry updates. The first one on page 4 is something that we're really going to spend some more time, certainly outside of this committee, on, and this is another of the DOL guidelines that were recently released on missing participants. You may recall last quarter we talked about some new DOL guidelines related to cybersecurity. I did want to just take a moment and really commend the university for the work that was done as a follow-up to last quarter's meeting. The University of Maine system, headed up by Tracy, really put together the single most comprehensive review of TIA's cybersecurity practices that we've seen from any client. And that's saying something, since we have over 2,000 institutional clients at CapTrust, many of which are universities as well. So again, you should feel really good about just kind of not only the cybersecurity process at TIA, but really the process with the UMaine system and kind of the audit of that practice as well. Similarly, though, the DOL did release guidelines related to missing participants, and really just to give plan sponsors some more details around what should be done from a missing participants perspective. And I don't want to take a lot of time in this meeting to go through this, but I just wanted to similarly inform this committee that it's something that we certainly understand, and it's something that we're going to work with the UMaine system and TIA just to make sure that the proper practices are being followed there as well. A couple other, just again, kind of topical spotlights, if you will, on diversity, inclusion, and retirement plans. Diversity and inclusion, obviously a very important and appropriately important topic, in the last few years. And it's something that actually even touches upon retirement plans and retirement plan designs. And so this page just talks about some of the ways that retirement plan designs can be tailored to really be more inclusive. And the good news here is if you go through really kind of the checklist, the UMaine system has already incorporated all of these features into their plan as well. So again, just a validation of what I consider to be an extremely well-run retirement plan. And then finally, just a quick CARES Act update here. You may recall a couple of years ago with this committee, we talked about the CARES Act. That was some fairly significant legislation that was passed impacting retirement plans, doing things like increasing the required minimum distribution age from 70 and a half to 72. There are some other features as well. The reason that we put this up is really mostly just to remind everyone that last year required minimum distributions were suspended as part of the what was going on with the global pandemic, and those have been reinstituted, meaning that required minimum distributions need to start up again this year. The reason that we think it's so important to remind everyone of that, not just our plan sponsor clients, but really everyone, is that if you look at the tax penalties that are applicable to retirement plans, the single biggest one is failure to take a required minimum distribution. It's actually a 50% penalty. So we're just encouraging, everyone to make sure, whether it be our own clients or just people that, maybe have had required minimum distributions or work with other plans, to just remember that. Again, TIA does a great job reminding plan sponsors and participants of that, but it's something that is very important. And then also, one of the things that we do, I think everyone knows here, we do regular fiduciary training, but we also incorporate aspects of that fiduciary training into each quarterly review. As we've said many times in the past, even though the plan is technically not subject to ERISA, we do follow ERISA as a best practice. We think that that's just a prudent process that should be followed, and that includes fiduciary training. Part of fiduciary responsibilities is ensuring reasonable fees. We have regularly fee benchmarked the UMaine system plan. We've been very fortunate as the plan assets have grown. We've consistently seen plan expenses come down as well, which is what we want to see. But there is certainly a continuum of benchmarking services that is provided, and they really range from everything from a fairly standard fee benchmark all the way over to a full scope RFP. We've gone through the standard fee benchmark and then the custom fee benchmark many times for the humane system, but it really has been several years since the system has gone through what we would describe as a full scope or even a limited scope RFP. And that's something that in a pre-call, Tracy and Kelly and some folks at CapTrust have talked about is perhaps initiating a more of a limited to full scope RFP at some point in the near future, because one of the things that we feel like we've consistently been able to show is that the humane system fees are at or arguably even below market. That's certainly where we aspire to be. But there's more to it than that. There's a review and a benchmarking of services as well, and that's something that a more of a limited to full scope RFP would do, is make sure that you're not only paying the right price for your record keeping services, but you're getting an appropriate service as well. And that's something that just we wanted to inform the committee that we are in discussions about that, and certainly we'll continue those discussions after this meeting as well. And then the final thing, when we talk about just some of the regulatory issues that are going on out there, and we just want to keep this in front of people. It's not something that has occurred yet, but there actually has been a proposal to allow 403B plans to offer collective investment trust vehicles. So right now, and really for as long as 403B plans have existed, they've been restricted to essentially variable annuities and mutual funds. That's just the regulations that apply to 403B plans. 401k plans have always been eligible for an additional type of investment vehicle called a collective investment trust, or CIT. CITs are essentially investments that are designed exclusively for institutional investors, and they're essentially kind of the next continuum, if you will, in the cost structure. So it would be a way to offer even lower cost investment vehicles to 403B plans. This is really critically important legislation for the humane system plan, because the biggest beneficiaries to this would be large 403B plans, which certainly the humane system plan falls into that category. So I did want to just bring this up. It's nothing that has to be acted upon now, but I wanted to let everyone know that we're certainly keeping a very, very close eye on this. We're lobbying on our clients' behalf because we think that this would really greatly benefit 403B plans. And so this is something that we're really just keeping in front of people, and want to let you know that if and when this does pass and CITs are allowed, it really is something that could significantly benefit the plan by again just offering even lower investment vehicles. Any questions at all before I quickly shift to some market commentary? Okay, I don't want to spend too much time on market comment. Yes, please go ahead,
Mike,
Sven.
can I
Yes.
ask you just two quick questions? So back slide 1, missing participants. Can you just expand on that? Are we missing them, meaning that we're not actually collecting them as they opt into the plan, or that as they leave the system, we're somehow missing that component?
That's a great point. And for just a little bit further explanation. So a missing participant is basically someone that in the defined contribution world has been enrolled in a retirement plan and then leaves the employer with a vested balance. And that the employer is not able to essentially track that participant down. So this happens fairly often. It actually happens a lot more frequently now in the era of auto enrollment. So what happens is, people will get auto enrolled in a plan. They'll leave the employer without a forwarding address. There's these what are called kind of force outs, if you will, where small account balances are automatically distributed. And then oftentimes those checks come back undeliverable. That's kind of one example of what a missing participant will be. The DOL has never actually had guidelines on how to handle missing participants. There's always been this kind of general concept that plan sponsors are required to make a good faith effort. Now the DOL has actually specifically laid out, here are the guidelines that plan sponsors need to follow to ensure that they're trying to track down those missing participants. It's also no show. I'm referring talking just on the defined contribution side, but it is an issue on the defined benefit side as well. But I think part of the reason we're seeing these guidelines now is because, again, in the era of auto enrollment, we're certainly seeing a lot more issues with missing participants. And that's not to say that it is a problem at UMaine, but it is something that, you still need to follow that process.
Thanks, Mike. Good.
Yeah, you're very
So
welcome.
final
Any other questions? Yep, I'm sorry. Sorry, Sven, go ahead.
The collective investment trust, the CIT, that would allow us to do things if that passes, that legislature gets approved. We could do even ETFs and things like that as investment vehicles. Is that right, Mike?
Yeah, so yes, but the biggest thing is really just the lower cost CITs. We think ETFs is a kind of a separate topic. We are not as enthusiastic, if you will, about offering ETFs in retirement plans for a variety of reasons that we won't go into. Even now, 401k plans can offer them, and we generally don't use them in retirement plans. But the advantage to the CITs is really just the fact that you could take an individual mutual fund where you're in the lowest cost institutional share class, and then have that same exact fund, same manager, same trades, same everything, just an even less expensive version of that. So it really is just a pure savings at the participant level. And again, you do have to qualify. So it's not like once CITs are available, you can just convert all your funds to a CIT, because there's still going to be minimum asset thresholds. And we would have to go through and really, kind of thoroughly evaluate which of your funds are even eligible for conversion to CIT. But it's something that we're definitely excited about, because we think it could really benefit some participants in retirement plans.
Thanks, Mike.
Yeah, you're welcome. So just some quick commentary on the markets. You can see here, this is through June 30th. And I think everyone knows here that we're through June 30th, the markets were certainly very strong. S&P 500, that's that US stocks column, up 15%. As we start to approach now the close of the third quarter, just a couple weeks away, S&P 500 through yesterday up about over 20%. So continued improvement there. International equities continue to do well, still hovering right around 9-10% returns. Really, when you look at the only weak spot, if you will, from a market perspective, it's in the bonds. And this reflects the aggregate bond index. And what you'll see here is that it was a strong second quarter. The aggregate bond index was up 1.8%, but year to date, still down 1.6%. This is really entirely a function of interest rate movements. I think everyone on this committee, I know, understands how interest rates impact bond performance. But basically, we did start to see interest rates rise earlier in the year. And the result of that is it has that kind of the opposite impact, if you will, on bond yields. So we saw in the first quarter, if you recall, aggregate bond index was down about 4%. Well, interest rates have really settled back down again. And the result of that is you can see here a strong second quarter, up 1.8%. But that really is it's a interest rate issue here when it comes to bonds, and we're going to talk more about that with your specific Core Plus bond fund in the UMaine system plan as well. Nothing to be concerned about. It's just the nature of interest rate movements and the effect that it has on really everything market related. Interest rates are kind of the foundation of everything market related, and certainly more so in the area of fixed income than almost anywhere else. The other thing we wanted to point out from a market perspective is that if you recall last quarter, we talked about this dramatic swing to value. So we had been for the longest time in a real kind of risk on growth oriented market. And then in the fourth quarter of last year and the first quarter of this year, not coincidentally, as interest rates started to rise, we also saw this swing to value. And as you can see here on a year-to-date basis, value, both large, mid, and small, continues to outperform growth on a year-to-date basis through June 30th. But we did see this rotation back, and you can see in the second quarter, things really kind of rotated back to growth and specifically, again, once again, the leading asset class being large cap growth. That certainly has been the case more often than not over the last couple of years. So we have seen this swing back to growth, but on a year-to-date basis, value continues to do well. I mean, when I look at this, it just, to me, continues to emphasize the importance of offering a well-diversified, lineup of funds, allowing people access to large, mid, small, international growth and value, active and passive as well. And you folks really do all of that. It's also, to me, why it's so important to have a really good, high quality default target date option, which is, in your case, the Vanguard target date funds, which I would argue is as good a default option as there is on the market as well. So, nothing here other than to just talk about the fact that, we consistently see these kind of swings, if you will, markets from growth to value, and also just throughout large, mid, and small. And then finally, from a forward-looking perspective, this is our headwinds and tailwinds slide that I think everyone on the committee has seen several times. Headwinds being things that are really negatively impacting the market or potentially negatively impacting the market, and tailwinds being positive. We continue to be really focused on the tailwinds. We think that there's a lot of good things going on in the markets, and certainly the overall economic and continued economic recovery. GDP numbers for the year have been extremely strong. Consumers, for better or worse, we're really a consumer-driven economy in the United States. About 70% of our economy is driven by consumers, consumer spending, consumer confidence, and consumers certainly have been doing their part in 2021, really driving the markets and driving, I should say, the overall economic recovery. So we continue to be very optimistic. I will say, though, that when you look at the headwinds column, what I find fascinating about this is just the timing of it. This is our June 30th quarterly review. And when you think about when this was put together, it was really mid-June is when our investment team starts to put together their headwinds and tailwinds slide. And as you read through the headwinds, it's the first time in over a year and a half where you might notice that there's no mention of COVID whatsoever in there. And, frankly, if you think about the timing of this, I just went back and just was looking at some COVID numbers in the state of Maine. And, we were down to about 30 cases at one point in May. And it really felt like we had gotten control of this. We had turned the corner, and it felt like COVID was, close to being in the rearview mirror. And, the result of that is that we were much more focused on things like inflation, the job market, which two items that continue to be meaningful from a headwind perspective. But now, we're right back to where we were kind of at the peak pandemic levels. And I think if we were to redo this, if you will, today, certainly I think the top bullet under the headwinds would be something related to the COVID surge or the COVID variants. And, when you start to combine now this resurgence of COVID with some of the inflation issues, albeit we believe mostly transitory in nature, but certainly real inflation issues. And then one of the bigger issues being the lack of the job market, the businesses that want to reopen and have not been able to because of the labor issues. There certainly are signs of weakness in this economic recovery now as we approach the close of the third quarter that we really weren't looking at, at the close of the second quarter. So again, I would say, for us, really is positive. We continue to be very optimistic for 2021, but certainly signs today, as we approach close of the quarter, that we're much more concerned about than we were just 3 short months ago. So I spent a little extra time on kind of the market commentary and the industry updates, in part because from an investment perspective, the plan is in great shape. I don't need to spend too much time talking about the underlying investments in your plan, but certainly we'll go through the scorecard and we'll go into as much detail as you'd like me to. But as you can see here on the page in front of you, just a snapshot of your fund lineup. I continue to believe you have an extremely well-structured fund lineup. You have all the critical asset classes covered on both an active and a passive basis. You have growth and value in all of those asset classes as well. And then, as I mentioned earlier, this QDIA, which is your qualified default investment alternative, being the Vanguard target date funds, I think is really kind of what I really consider to be the foundation of your plan, and certainly a strong foundation as well. We highlighted one change. You may recall at the last quarterly meeting, it was approved to terminate the Carillon Eagle Small Cap Growth Fund and replace that with the Mass Mutual Small Cap Growth Fund. Carillon had been in your plan for several years, and we started to see performance lag. We saw the performance turn around as the market rotated, but then we really did see that performance lag significantly. And year-to-date performance, really, frankly, has kind of validated that decision that was made. That was effective July 28th. So Carillon was removed from the plan. It was replaced with Mass Mutual Small Cap Growth Fund. Carillon year-to-date through yesterday is only up about 5.5%. Mass Mutual is up almost 10%. And Carillon year-to-date still down in that kind of 85th to 90th percentile as well. So again, really, I think kind of validating that was the right decision. No additional change recommendations, though. The next page, you can see just a summary of the assets, and I won't go through all of the following pages in great detail, but you can see, suffice to say, we continue to see really strong growth in plan assets, almost $2 billion in the plan as of June 30th. I think realistically, if you were to pull the assets in the plan as of today, you're certainly over that $2 billion threshold. So again, just a really healthy plan growth as well. Down in the bottom left-hand corner, there are some old, what we call kind of frozen assets out there as well. But frankly, for a plan your size, it's a relatively small amount. And we continue to, we think that most participants are better off in the core plan than in some of the frozen plans. But again, we track those as a service. And then finally, the next couple pages really just kind of break down, if you will, where the assets are in the plan. And you can see we continue to see kind of the largest single category being fixed income, driven a lot by the TIAA traditional account. But overall, I would say pretty good diversification in the plan, with definitely a lean towards certainly the more conservative approach. I would argue that this is really a function of kind of the older employees with larger account balances that have a lot of money sitting in TIA traditional. I think if you were to look at just kind of the people who are coming into the plan over the last decade, this pie chart would look very, very different. So I'm going to just kind of, in the interest of time, I'm going to go through these next several pages really quickly, not even really pause on them, but I did want to point out that they're in there if you wanted to go and you wanted to see asset totals kind of broken down by each plan. Certainly that report is in there as well. So as I go through this, I guess I'll just pause and see any questions so far on anything that I covered, plan related or even market commentary related.
Mike, I have a question.
Okay.
If you could back up
So
that slide.
from a scorecard, yes.
Oh, sorry. Can you hear me?
Yes, I can. So back up to the
Okay.
pie chart slide.
Yeah, the asset allocation slide. And I was just, when you mentioned that, our fixed income allocation is due in large part to the TIA traditional. I recall that having a sort of a fixed return, or maybe it was a minimum return of maybe 3%. And then I was thinking about the bond returns that you showed for fixed income being even negative this year. Is there any issue with that, or are they still keeping their promise as it is to maintain that rate of return?
Yeah, that's a great question and great point as well, Eric. I actually consider, when you look at kind of the current market, if you will, if you're an investor right now that is near retirement, in retirement, concerned about perhaps the equity environment, thinking that maybe it's overheated and not wanting a lot of exposure to equities. But to your point, and the point I made earlier, it's very difficult to make money in bonds right now. Bonds are kind of a challenging, very challenging place to be. That, I would argue, is the beauty of having a really good, high quality fixed account like you have in the plan. I mean, that account has a minimum guaranteed rate of 2.75%. Right now, that's, virtually unheard of in the market outside of TIA. But also, if you look at some of the participants who have been in that particular investment for a longer period of time, depending on how long they've been in there, some of their asset pools could be earning as high as 4%. So yeah, I mean, I would say, that is an excellent investment. It is backed by the financial strength of TIAA. I think, to your point, are there concerns about the investment? And I would argue no. TIAA is one of the single most financially sound, organizations in the nation. So there are no concerns there. And, in terms of the guarantees, it is what's called a guaranteed account. But we feel good about those guarantees and kind of the structure of the overall TIA investment portfolio that's going to allow them to continue to pay those guaranteed accounts. So kind of a long-winded answer to your question is no, certainly no concerns about it. And in fact, I would say just the opposite. We think that times like this are why it's so important, and it's great to be able to offer something like that. The only downside, I think, as everyone knows, to that particular investment is that there is a kind of a lack of liquidity compared to, say, a money market or some other stable value accounts, in that it does require a 9.5-year payout. So it is a kind of uniquely structured fixed account that requires people take their money out over a period of time. But we believe that the trade-off for what you're getting with those higher yields on that is well worth that less liquidity, if you will.
Yeah. Great. Thank you for that, Mike. That's very helpful. And I totally agree that if you're looking for a safe place to put money right now, it's a tough market.
Yeah, and I would actually take it a step further and just say, on a personal level, I wish I had access to something like that, where you can get that type of guaranteed. On a personal level, I would be pretty comfortable trading off some liquidity for that type of yield. So just jumping ahead to the scorecard, the scorecard really looks great. This is, I think, about as clean a scorecard as we've seen here with the UMaine system plan. So I'm not going to spend a lot of time quickly going through the equities. You can see everything really scoring on this page in the high 90s, a couple funds scoring a perfect 100. If you look at, based on our proprietary scoring system, which granted, I always like to say is just one part of the evaluation process, but we think it's an important part of the evaluation process. It is something that's written right into your investment policy statement, which we're going to talk about later in the meeting. But when you're scoring a 97, 98, 100, that's really indicative of top quartile to top decile, peer relative and risk adjusted performance, no qualitative issues, no style purity issues. So again, from an equity perspective on this page, you can see everything really in good standing, and certainly no concerns and obviously no change recommendations. Your lowest scoring fund here, it's again, not coincidentally, your lowest scoring funds, I should say, are both in the bond asset class for different reasons. With CREF, inflation protected bond fund, the peer relative performance has been below the 50th percentile for 3 and 5 year periods of time. We're actually not concerned about that. We continue to think that that's a really well managed fund. Same thing with PGIM total return bond. You can see the risk adjusted performance, there are issues, and then some style issues as well. Really, both of these are just related to duration plays on both of these funds. So just looking at PGIM, which we believe is really your kind of core bond fund. It's technically a core plus bond fund, but we think it's really your primary bond fund. That fund, I do like to point out, still in good standing, scoring an 82. So no concerns about that from a scorecard perspective. But when you look at that fund, and the reason why you have those style scores and the risk-adjusted scores, it really is kind of a duration play that PGIM made. And as I mentioned earlier, when we saw this kind of spike in interest rates earlier in the year, kind of late last year, early this year, we did see the performance of that fund lag significantly during that spike. PGIM felt very strongly that the Fed was committed to keeping interest rates low. They felt very strongly that kind of the duration of that portfolio was appropriate. And that thesis has really played out. If you look at the performance of that fund in the second quarter specifically, so again, as interest rates did settle back down, that fund was up through in the second quarter over 3%, and it was in the top 2% peer relative. So it beat 98% of the peer group. So, it's still on a year-to-date basis, because of the first quarter performance, it's still down in the 70th percentile. But I also like to point out in fixed income, everything is very, very tight. So the difference between 70th percentile and 30th percentile is really not that dramatic. And so again, we think that we've been in kind of this unique interest rate environment that has caused some excessive volatility, if you will, in the fixed income space. But we continue to feel really good about both of those investment options. And I do like to point out they both are still in good standing from a scoring perspective as well. On the next page, as we get into some of the more aggressive asset classes, specifically small cap, you can see the only fund marked for review here really is that Carolina Eagles Small Cap Growth Fund, which continues to be in the report because this report was through June 30th. The fund came out July 28th. That fund at this point has been replaced with the Mass Mutual Mid Cap Growth Fund, which is scoring exceptionally well and having a decent year. Small cap is also a very challenging space, frankly, especially for what we consider to be quality managers. And there's just been some unique things going on in the small cap space, which has caused some lagging performance amongst some of our managers. But again, we think long-term, really, really good positions there. And then finally, the Vanguard Target Date Series continues to do very well, scoring a 95. I did want to just quickly point out one change with Vanguard that we think is important. We think it's important just to note, and that is that Vanguard has changed their rebalance policies. So basically what rebalancing means in the target date space is they have asset allocation targets that they follow. And depending on market performance, the portfolio can get out of line with those targets. So an example would be if you have a run up in large cap growth and the large cap growth component of the series does well, then you're obviously going to have more money in large cap growth, and that would cause them to rebalance the portfolio. Vanguard's rebalancing policies have always been basically 75 basis points. If an area gets out of target by more than 75 basis points, they will rebalance historically to within 50 basis points of the target. Well, as you can imagine, with kind of the run-ups that we've had in the market, what that has caused is really frequent rebalancing because, that's their policy. They have to adhere to that policy. So the result of that is that frequent rebalancing, the downside to that is that adds to costs. So more trading means more costs to a portfolio. So Vanguard has decided to change their rebalance policy from 75 basis points to 200 basis points. So basically what that means is that they'll rebalance when they get off target by 200 basis points or more. The result of that is really far less frequent rebalancing. And the other result would be, less expensive trading costs as well. I also like to point out that 75 basis points actually had Vanguard about as tight as anyone or tighter than most in the market in terms of their rebalance policies. 200 basis points is much more in line with market. So we have no concerns about it. In fact, we think that this is a positive thing because it's going to reduce trading costs, but it is something that we just want to make sure people are aware of, and it's detailed a couple pages ahead in this portfolio, in the report as well. And then finally, just wrapping things up, your full suite of index funds are all in good standing as well. And then the CREF stock and TIA real estate, which we break out as distinct investments, both of those are in good standing. And your average plan score of a 95. Again, just one part of the evaluation process, but I do think it's a meaningful and important part. And certainly, I think you should feel good about just the overall condition of your plan. Certainly from an investment perspective, the plan's in great shape. I would argue just from an overall, fiduciary management perspective, the plan's in outstanding shape as well. And so I'll pause there. There is one other kind of quick agenda item that we wanted to go through, but I want to pause there and see if there are any questions or if anyone would like me to go into more detail on any specific investments in the plan. Okay, great. Kelly, so we do have one other agenda item. I don't want to go there. I don't want to break the formality of the meeting, but do you want me to just?
Yeah, so we're going to move. I just wanted to make a comment on the Vanguard rebalancing. It's almost funny. You sneeze in this market and you would have been rebalancing all the time. So I'm kind of glad that they changed their policy on that, because the way it's volatile, it's always rebalancing. So so I'm going to pass the meeting back to you, Mike, for you to review the investment policy statement with us. Tab 3.
Yep. Okay, great. Thanks a lot, Kelly. Yeah, so I'm kind of going through this right now. Another attachment that you had as pre-work to this meeting was our investment policy statement. The investment policy statement, I feel like I've used the word foundation too many times today, but the investment policy statement really is kind of the foundation of what we do. It really details the process that we follow. And when I say we, I mean at Cap Trust, but as a committee as well. And then in addition to that, there's an addendum to the IPS that also really details our scoring methodology and goes through that 100-point scale in great detail. We think that it's a good, meaningful investment policy statement. It's one that's been certainly reviewed many, many hundreds of times, if not thousands of times. We do not have any changes that we're recommending to the IPS, but we do believe that it's just a good, sound fiduciary practice for committees to periodically review the IPS. I think especially, with some new committee members as well, it's a good time to really take a step back. And I think it kind of clearly lays out what our procedures are, what our role is, and then what the process is that we follow. So what we're asking is for really a review of the IPS. We obviously want to document that the IPS was distributed, and we'll put that in the meeting minutes. But we also think it makes sense, even without changes, we think it makes sense to periodically have it signed and have a new date on that investment policy statement as well. So we've included that in the packet. We are asking that if everyone could just take a look at it. If you do have comments or questions, by all means, we're happy to answer those. And I know that if you haven't had a chance to review it before this meeting, even as a follow-up to this meeting, you can reach out to me or Barry, and we're happy to answer questions about that. If there are no changes requested, then we would just ask, we think of having a freshly dated signature on the IPS, just as part of documentation of the process does make sense. And so I'll pause there and see if there are questions, or if you would like me to go through kind of any aspects of the IPS. I'm certainly happy to do that as well.
Mike, just more of a clerical point. Are we going to send a copy that needs signed by trustees out to trustees for signature?
Yeah, so maybe Tracy, perhaps it's best for you to ask. I don't believe that we had trustees sign the last version.
Right. That's fine then.
That's correct. We don't actually sign it, but just really acknowledgement, that the policy as it stands is appropriate, or if you have any changes, to say that. Otherwise, the minutes will just reflect approval of the existing minutes rather than, not an approval because we don't have an action item, but acknowledgement that the investment policy statement continues to be appropriate.
Great.
Thank you.
Any other questions for me? Well, Kelly, you can see it's far more efficient with me just doing it than Barry doing it, because we have 5 minutes to spare with me going through the review.
Well, thanks, Mike, for your market commentary and your insights. It's always very helpful to hear this, and I always enjoy these because, you know, listening to this, it helps us to be great fiduciaries to this money, but also in the background, we're thinking, personally, what is this doing for our retirement portfolios? You know, so it's always very good information, and it's really some years easier than others, and I can't really say that the last couple of years have been a little bit ridiculous, so it definitely financial advisors and consultants, in this last go around, the last 2 years with the pandemic and interest rates going down, everything swinging all over the place. It's definitely interesting to hear what you have to say and what the outlook is. It's definitely a crazy time out there. So thanks for all you do.
Well, thanks, Kelly. Well, suffice to say, we are thrilled to be here and to be able to do it. And I do like to point out, when the scorecard looks that good, sometimes I say, just a reminder, it's not going to always look this good. So, we certainly have, to your point, we've had a really good run in absolute terms, and fortunately, we've had a really good run in relative terms here as well. So.
Trustee Martin?
Yes.
Could I just comment on the cybersecurity, the earlier compliments from Mike Pratico? I would be remiss if I didn't acknowledge that I was the facilitator, and that John Forker, our Chief Information Security Officer, of course, did all that work. Those of you who were probably in an FFT meeting knew yesterday that I could hardly get my mic to work. So I just wanted to mention I was not the driver on that cybersecurity, but facilitated. But thank you very much, Mike.
Yeah, well, it was, again, that was a very, very impressive report that your cybersecurity person put out. It was just as comprehensive, as I mentioned earlier, as anything that we've seen with any client. So I think everyone, really from a participant's perspective, because that's what this is all about, should feel very good about the work that's being done from a cybersecurity perspective. So
thank you.
Okay, I guess with that, I will sign off and thank everyone for your time this morning.
Thank you, Mike.
Okay, bye-bye.
Okay, on to our next agenda. And so our next item on the agenda, tab 4. And this is an action item. Just to give you a little background, through a competitive procurement process, University of Maine System has engaged CapTrust Financial Advisors to perform investment advisory services, and that commenced on January 2, 2013. This was a 7-year contract with 3 one-year extensions. Management recommends that the investment committee approve a contract extension through to calendar year 2022. The extension is based on the terms of the RFP and CapTrust pricing provided in 2012. CapTrust fees are $99,373 for the calendar year 2021, and the contract allows for a CPI-U based on an annual increase capped at 5% annually for a maximum annual fee for the calendar year 2022 of $104,341. I'm going to read the text of the proposed resolution: that the Board of Trustees, acting through the Investment Committee, approves the extension of CapTrust's appointment as the University of Maine System's investment advisors for the contributory retirement plans for calendar year 2022. Do I have a motion?
So moved.
Moved by Trustee Donnelly. Second?
Second.
Seconded by Trustee Bartholomew. Any discussion before the roll? Okay, without further, Ellen, can you please call the not the roll, but the vote?
Certainly. Trustee Bartholomew,
Yes.
Trustee Donnelly,
Yes.
Trustee McMahon,
Yes.
Trustee Martin.
Yes.
The motion is carried.
Thank you. And then our tab number 5. Kelly, are you on the phone? Jay?
Hey, everyone.
Hey, how are you? I think we're rolling pretty quickly here, so I was worried that maybe you guys weren't on yet. So
We are here.
I'm basically going to transfer the floor to you, Cal, to go over the performance review of the management investment pool, defined benefit pension plan, and the operating fund portfolios. So thank you for being here today.
Wonderful. Well, good morning, everyone. I'm also joined by Jay Roney, who you all know. Jay is going to walk through a short market overview. We know you just heard from Cap Trust, but he will touch upon some market performance. Markets were excellent during the second quarter. And then he will walk through the plan or the fund performance for the 3 portfolios. And on a fiscal year to date basis, your fiscal year end, all 3 portfolios performed exceptionally well with some very strong absolute results. So he'll walk through those as well. So I will share my screen and turn it over to you, Jay.
Great. Thank you. It's great to see everybody today. I picked up on the tail end of Cap Trust presentation. It seemed like it was very well received. And I came in time to hear that the last several years have been ridiculous. So that was the first sentence I came in on. And I echo your comments that you made, Kelly. So very observant. They have been ridiculous. Oftentimes, as a consultant and institutional investors, we lose sight about just how good those returns are. So I'm going to share some of that news with you today. Obviously, it seemed like Cap Trust did a wonderful job and did a tremendous amount of heavy lifting with the market. So I'm really going to emphasize one point, and it's how well growth stocks really did during the second quarter. And you can kind of see that at the top of the page under the quarter category, large growth versus large value. You see 11.9% return for growth and 5.2 for value. That was really driven by excellent returns in the technology sector during the quarter. And at least from my perspective, and hopefully Cap Trust kind of echoed these statements earlier, but it really seemed like 2020 all over again, the second quarter. So the pedal was to the metal in regards to the markets, and things have obviously slowed down more recently. As a result of the strong markets, Kelly, if you could turn to page 140. As a result of the strong performance on an absolute basis, I heard Cap Trust talking about absolute and relative basis. On an absolute basis, all the asset pools did incredibly well based upon the goals and objectives that they had before them. Suffice it to say, some of the managers did fall short, particularly over the last year because it was such an aggressive market. But I'm happy to say that during the quarter, a lot of those managers that underperformed for the year really outperformed. So things are headed in the right direction, and we're very happy with some of the changes that have been made over the last year and two. But if we do look at page 140, I did want to highlight performance, and you see that in the upper right. If you look at the quarter returns, the MIP returned 5.1% during the month. And over the fiscal date time period, so for the whole prior year, the plan was up 27.1%. You do see the relative underperformance of managers if you compare the composite to the allocation index. But on a quarterly basis, there's only a 20 basis point degradation in performance. So again, things are headed in the right direction, and we're fairly excited about that at this point in time. If you take a look at the upper left-hand part of the chart, that shows you the asset allocation of the strategy into its equity and fixed income components. And I'm happy to say that you're in compliance with your asset allocation policy. And during that time period, assets ended the quarter with $444 million in assets. And that's an increase of roughly $20 million over the last quarter. So again, that's going to be very beneficial to the university system in general. If we take a look at the bottom right, you do see some recent actions, and you'll notice that we have no recommendations for you today in regards to the MIP. We conducted some rebalancing where we took some money out of your TIPS allocation. Those are Treasury inflation protected securities, as they had a huge run up, and allocated some of that capital to core bonds. And there are no due diligence items coming out of your investment managers at this time. So that's all good news. If we turn the page, we can do a quick review of the pension plan. That's page 142, 141. And you'll see the performance there as well. The same story really exists that was in the MIP, but the implementation of the strategy is much more conservative in the pension plan because of the specific goals and objectives there, as well as the implementation. If you look at performance, you're up 4.3 during the quarter and 15.9% during the month. And again, if you look at the asset allocation, you'll see more fixed income investments that are in the endowment pool, and a smaller allocation to equity. The pool is much smaller than the MIP. There's about $25 million of assets in this pool as of the end of the quarter. And even though the portfolio did quite well, up 4.3 for the quarter, all that really did, and again, I shouldn't say the word all, but you were fortunate enough that those gains paid off the benefit payments that were paid to retirees during that time period. So the plan during the quarter was self-funding, which again is positive news. Again, there were no announcements by the managers. We reallocated some of those assets from TIPS into core bonds. And again, we have no recommendations with the pool of assets at this time. If we take a short look at the operating fund on page 142, we find a better story, even though the numbers are smaller. We have great asset returns, again, in line with the goals and objectives, and we have significant solid manager outperformance in aggregate. So again, we're very happy with how this pool is operating. Again, if you take a look at the upper right, and again, please bear in mind that most of the assets are invested in fixed income type investments, but you had a 1.4% return during the quarter and a 7.7% return for the past year. And again, if you compare those composite numbers to the allocation index, you see significant manager value add. Over the last year, that was about 160 basis points, and it was relatively flat during the quarter. Now, the asset allocation is a little bit different. The operating fund is divided into 3 different pools. Most of you probably know this, and those pools are outlined in that pie chart. You have a liquidity pool, which is incredibly liquid securities that basically have little to no principal fluctuations. So you're just there for liquidity purposes, paying expenses and using capital that's needed to fund your operations. You have an income pool that will take a little bit more duration and credit risk. That's about 24%. Actually, that's a majority of the pool at basically 47%. In that dark blue. And then you have a total return pool, which is meant to be longer term assets. And there we sprinkle in some equities as well as longer duration securities. And that's roughly 24% of the pool. All those pools and those allocations are within asset allocation targets. You know, we're in great shape there. And there were no new announcements with any of the fund managers at that time. And we did take action during the quarter. At the last meeting, the committee approved the termination of Luma Sales Bank Loan Strategy, which was replaced with Bain, the Bain Bank Loan Strategy. Again, we had the Bain Bank Loan Strategy in some of the other pools, and we just wanted to, and they had better performance, and our expectations for Bain are greater than Luma Sales, so we made that change at this point in time. Again, no recommendations will be made at this time, and we're very happy with the asset allocation as well as the performance. Before I move on to how some of the individual managers performed, does anybody have any questions about the three pools? Great. Kelly, if you turn to page 143, we're going to spend really time on two of what we call the flash reports, and we're going to discount the pension plan because a significant majority of those managers are included in the other pools, but we'll go over the MIP in detail. Kelly, do you want to try to blow that up just a little bit? I know most of us wear glasses, but the print is still tiny. Great. Can everybody see that? Maybe a thumbs up or a thumbs down? Thumbs up, thumbs up. Okay.
This is what I like about Zoom meetings. I'm interrupting, but it's nice and large on my screen. So I like the investment committee Zoom meetings for that reason.
Okay, great. You know, highlighted in the gray boxes are really all the investment managers that you employ, and you see the variety of the time periods going across the front page. You'll see the returns, the performance returns of the managers really in the first part of each column. For instance, the S&P 500 during the quarter was up 8.5, and the ranking is directly to the right there, and it says 26%. That obviously means that the S&P 500, in which you invest in the index, returned 8.5%, and it was in the top 26 percentile of the universe. I think I just want to, piggyback on what I assume was the Cap Trust explanation at the end, about how difficult it was for managers to add value, and obviously their managers are doing quite well at this point in time. But I just want to point out one number. All the way to the right, you see a 10-year number for the S&P 500, up 14.8%, which is a great absolute return, obviously. But just to show you how difficult it is for managers to add value, the index was in the top 14th percentile of the universe, which means that 86% of the active managers that do large cap investing have not added value over the last decade. And that's why we're passively investing in that space, because it's hard to find consistent managers that outperform on a regular basis. In many other areas, obviously, we have active managers, and they've had mixed results based upon their strategies. Significant action has taken place in the last couple of years to round out the portfolio better. You might remember a number of years ago, the plans were really populated with value-based managers that really protected on the downside. We've taken efforts to add some growth strategies over the last number of years to better balance the growth and value metric. Regardless, a fair number of your growth managers are a little bit more conservative in general, meaning they usually purchase companies that actually make money rather than concentrate on growth, while not making money. And they also might protect on the downside relative to other growth managers. But as we go down the list, we do have two small cap managers, small to mid cap managers, Westfield Capital and DFA. Each one of those managers have done quite well if you look at the absolute returns. But what's interesting, when you combine both managers and compare them against the appropriate index, and you see that in the darker blue category called total domestic mid-cap equity, you find that in combination, they're doing just an incredible job. If you look at the fiscal year-to-date numbers or the last year, you see a 63.5% return in the top 27th percentile. Again, 73% of the managers are underperforming the combination that you've put together. The same can't necessarily be said for the global equity manager, Walter Scott. They had a very difficult year. Difficult year meaning they were in the bottom half of their peer group, but they still had a 34.4% return. They reversed things in the last quarter. and they were up 8.2%, 8.2%, landing in the top 32nd percentile. Again, so their performance has turned around markedly, and we hope for much better things coming from them in the near future. From an international equity perspective, you have a value manager with Morgan Stanley and a core manager with J.O. Hambro. The performance over the past year hasn't been great out of that group, but at the same time, we see very promising things coming out of Morgan Stanley during the second quarter, up 6.5%, again, landing almost in the top quartile. J.O. Hambro's performance was lackluster at 3.8% because they have an overweight to financial stocks, and we're hoping that turns around in the very near future. Kabuter is a very interesting story. They had an incredibly strong performance during the quarter, up 6.5%, landing in the top half. That's a dramatic reversal from the past. As you might remember, that is a core ESG activist strategy, meaning they buy positions in companies. They intend to hold them for a long period of time. They develop relationships with the management, and they affect change from the inside. And again, it's great to see the positive performance data coming out on the second quarter. The emerging market strategies, Aberdeen and Mondrian, listed below from emerging markets. The story is very similar to what we saw in the small cap space. In aggregate, those managers are doing quite well, even though they're falling short of the index. If you look at the 1-year performance, they're up 51.3%, and they're landing in the top quartile of all emerging market managers. So again, the combination of the two are developing superior results versus the average manager out there. If we turn the page to 144, I want to highlight the performance of the fixed income. The story here, as I went through, the story is a little mixed on the equity side. The story on the fixed income side is incredibly positive on an absolute basis, but also on that relative basis. If you take a look at the top row in blue, you see a 2.1% return over the quarter, 1.3 year to date, and an amazing 7% return over the last year in a low interest rate environment where spreads have compressed quite dramatically. It's important to realize that over the past year, you received that 7% return, and the index, meaning the Bloomberg aggregate index, which is kind of the traditional investment grade US index, had a negative 30 basis point return. So we took a number of moves a number of years ago to position this portfolio to really excel in this time period. You have a relatively small allocation to the Bloomberg aggregate index. That's with Common Fund. They've added an incredible amount of value in the last year, up 3.2%. But your TIPS allocations up 6.5% and 5.9% during the last year helped. And what really helped are those go anywhere strategies that take on a little bit more credit risk. There's a little foreign exchange risk in there, as a little duration risk, have added 8.4 as well as 14%. So again, that strategy is working out incredibly well, and we expect great things going out of that moving forward. As we move down the page, we have Newton Global Real Return. That's a balanced strategy with equity and fixed income. It really shows its true colors in very adverse markets where it significantly outperforms by thousands of basis points on occasion. And we witnessed that during the most recent downturn where they did incredibly well. Because they really protect on the downside, they truly aren't going to keep up during this market environment. And of course, they do have an ESG focus, which has been beneficial to put in the portfolio. Lastly, I'll take a quick look at some of the more alternative strategies. You have Lighthouse, which is a long short equity hedge fund that's up 20% in the last year. And you have Landmark Equity, which is a private equity fund, up an amazing 48.5% allocation over that time. Obviously, those strategies are risk constrained, so we don't have incredibly large allocations to them as you'd expect. If there's no questions, I'm actually going to skip over the pension fund managers, and I'm going to go to the operating fund. And I wanted to
Hey,
point
just
out.
one quick question for you before
Yep.
we move forward. You mentioned earlier in your briefing, Jay O'Hambro and Walter Scott. These are newer managers we've hired in the last 18 months or so. Both underperform peer. We have confidence in future results with these two.
We do have confidence in the results, but obviously we're watching them very closely at this point in time. The reality, as Chairwoman Martin mentioned earlier when I jumped on the phone, these markets have been truly incredible, and they've really rewarded those managers that generally take significantly more risk. So obviously, we want to try to balance managers that can outperform in the short run versus those that can outperform over complete market cycles. These plans are going to be around for a long time, and we want to make sure that that we have the right balance. But again, we share your disappointment, in some of these manager returns, but we really do think they're going to provide excess returns over time, and more importantly, when you need those returns in adverse markets. Kelly, do you have anything to add?
Well, the reason I say that, Jay, is they're about 15% of the portfolio, right? So these two together, and so we're as long as we're comfortable with it as our, I was just elevating it for awareness, I think.
Yep, and I definitely appreciate that. We are very aware of it every time we look at the reports. Kelly, I hate to, you're on mute, but do you have anything else to say about those two managers?
Sure, I would just remind, and I think Jay, you mentioned this a little bit, just remind the committee that these two managers were put into the portfolio through portfolio construction to add a little bit more growth equity to the managed investment pool because there was so much of a value tilt. But we didn't want to go all the way aggressive growth, because growth has such a huge run up. So we worked with the committee and ultimately selected managers with a growth tilt, but are a little bit more core in nature. So they're not as aggressive as some of the other managers in the universe that are the top quartile managers at this point in time. I do think when things normalize a little bit, these managers will start to rank better. Again, just wanted to be careful with the risk posture and some of the managers that we selected for the portfolio. Again, be a little bit more conservative growth than aggressive growth.
Great. If we do take a look at the operating fund on page 146, we do highlight all the managers in the three individual pools that I highlighted earlier in this discussion. The first third of the page is really that liquidity pool. In the middle of the page is that income pool, and the total return pool is below. All three pools have performed very well. You have roughly 30% in that liquidity pool. Over the last year, it just earned 50 basis points. And again, a significant majority of those assets are in money market type investments or the state pool, which is incredibly conservative. Again, as the Fed keeps interest rates low, you should not really expect any return out of it. Basis points, not hundreds of basis points. So when you take a look at this portfolio, if interest rates move higher, that could be beneficial. If we go to the income pool, again, this is where you take a little bit more duration and credit risk. And you see that 3% return on a year to date there. And you see every manager below, Income Research and Management, BlackRock Strategic Income Opportunities, Baird and Bain is a new name in that list. All of them have added value over and above their indexes, and that's about half the portfolio. And then again, about a quarter of the portfolio is that total return pool at the bottom. And again, we've talked about all those managers really except one. You have Lighthouse, which is that long short equity manager that's done well. You have Newton, which is very conservative in nature, which I believe you want in an operating fund. And you have that Vanguard Total World Stock Index Fund, which has done amazingly well, up about 40%. And then you have that PIMCO All Asset Fund. And again, that PIMCO All Asset Fund, we've talked about that in the past, but it is really a very diversified pool of assets in which about 70% of them right now are allocated to sectors of the market which are very sensitive to inflation. So it's really there for inflation protection. So it has a lot of emerging market equity, emerging market bonds, TIPS, REITs, as well as commodities in there. And that is up roughly 30% in the last year with a great return of 6.1% during the last quarter. So we've been very happy with them. So the operating fund has done very well. You know, as Cap Trust mentioned when they were signing off, these returns are a little too good to be true. So we are obviously going to be taking a look at asset allocation in the near future and might make suitable recommendations to make changes. The real driver, if we make changes, would be the fact that spreads, credit spreads have compressed so much. Perhaps Cap Trust talked about that. And that has driven a lot of these great returns. So we might, on the margin, potentially get a little bit more conservative in the near to intermediate future. On that note, I appreciate your time going over the performance with these funds. We do realize a number of the managers continue to underperform, but we've seen some great improvements with some of the managers just in the last quarter. So we think we're positioned properly at this point in time. But again, you might see some short to intermediate term recommendations coming up in the next couple of meetings. Any questions before we wrap things up with performance?
Yeah, I have just a quick question. Part of it is probably my relative newness to the committee. Going back to the MIP for a second, we have an investment allocation to U.S. equities that's pretty diversified, and then an investment allocation to international equities. I'm just wondering what the purpose of having a category of global is, and why not just allocate to additional U.S. or international managers? Because in one sense, you're essentially giving up some of the asset allocation decision making at that point. Is it because we like that specific manager, or have we always had a global allocation? Could you just talk me through that a little bit?
Yep, we haven't always had a global allocation. That really has been a newer manager that we have put in. But we think because they have that additional flexibility in individual stocks and markets they can invest in, good managers in that space can add significant value over time. Again, they just have a few more levers than those individual managers. You're obviously correct in stating if you allocate to a global manager, it does take away your ability potentially to affect asset allocation because you put somebody in charge of kind of that allocation to international versus domestic. But that's why we size things appropriately at that 10%. You will notice that if we go to page 145, Kelly, in the pension plan, we actually took action over the last year, actually, over the last year, 2 years actually, to simplify the plan. Again, there's only $25 million in the portfolio, and it was getting a little unwieldy with all the strategies that we were implementing, that we said, let's take a majority of the international and domestic equity managers and just roll it into global fixed income. We think that's an efficient way to run a smaller pool of assets. We just wish, as we mentioned earlier, that their performance was better, but we do have a great deal of faith with them, in them, over the intermediate to long term. Matthew, does that answer your question?
It does, thank you.
Okay. Any other questions before we wrap up this section?
Just quickly leveraging off of Matthew's question, are there curbs in how far that global equity fund can move toward domestic versus international?
There are curbs. Right offhand, I don't know what those are. Kelly, do you have any idea?
So they do have guidelines, and we can follow up with the actual guidelines. Typically, if we look historically at Walter Scott, really haven't seen them go above 70% US equity. And so that's typically what I've seen in the past when we look historically, kind of where their US equity exposure would top out at.
Great, thanks.
And if you think today where the MSCI All Country World Index is, the Global Equity Index, it's about 60% US equity. So you'd expect that Walter Scott, the majority of the strategy would be US equity, and then the remaining 30% or so diversified through international and emerging.
Great. I believe on that note, I'll wrap things up, and we can move on to the next agenda item. And I believe I'm happy to say that I'll get out a little bit early today, right? And continue your day.
Well, thanks, Jay, for your commentary. I always like to. You're finished, right?
Yep.
Okay. I always like to compare financial consultants to captains and first mates out at sea. It's definitely nice to have your guidance and expertise. And the waters are not always very smooth, and we never really know sometimes when things will change up. So very thankful for your comments here today. And that brings us to the end of our agenda, public agenda. I do want to acknowledge, I know that I did thank Eric for his service as a non-voting member of our committee, but I also wanted to acknowledge Jim and Matt. So for Jim Bradley joined our committee back in May, and Matt Scaves was on the last committee. He was part of the last committee meeting, but he officially gets on, I believe, in October. So I want to welcome them both to the investment committee, and obviously we just heard from them with great questions. Jim Bradley is a founder and chief investment officer of Penobscot Financial Advisors, and is no stranger to the University of Maine. And same goes with Matt Scaves, as a chief investment officer of Began Wealth Advisors, and both are very well respected in the industry, hold well respected industry designations as well. So thank you for joining our group and helping us as we make decisions in the best interest of the University of Maine system. So, any other questions and concerns of the meeting so far? Without further ado, we're going to go into an executive session. Could I have a motion for the investment committee meeting to go into an executive session under the provisions of 1 MSRA section 405(6)(c) to discuss the condition, acquisition, or disposition of real property or economic development if premature disclosure of the information would prejudice competitive or bargaining position of the University of Maine system, and 1 MRSA section 405(6)(e) to consult with its attorney concerning legal rights and duties of the university. Do I have a motion?
So moved.
So moved by trustee Bartholomew, second.
Second, David.
Second by trustee McMahon. Ellen, can you go through the vote?
Certainly. Trustee Bartholomew,
Yes.
trustee Donnelly,
Yes.
trustee McMahon,
Yes.
and trustee Martin.
Yes.
The motion is carried.